Now, there's no doubt that investors these days are seeking out income ETFs, specifically high income ETFs. Now, a lot of people are interested in NEO's funds, and they have some amazing ETFs such as QQQI, which has won the ETFawards.com Best New Active ETF. And they've done it for good reason. It's been consistent, pays out high income, and has upside potential. So in this video, we're going to be going over an ETF that's quite underrated and has been beating the S&P 500. But let's take a look at first what NEOS has to offer. So of course we have QQQI, which is going to be the NEOS Nasdaq 100 Index ETF, and it's going to give you monthly income about 14%. So it's pretty solid. It's not as high as some of the ETFs by YieldMax, but you're going to get consistency with this ETF. Now, if we take a look at what exactly they have in terms of their lineup, we have equity high income ETFs in terms of SPY-I, QQQI, IWMI, and then we have a new one, which is going to be NIHI, which I'm not too familiar with, but the first three are going to be very similar strategies. It's going to be selling covered calls on about half of its portfolio, and it's going to be very tax efficient. That's probably the main draw for NEOS ETFs. Not only are you going to be getting monthly, reliable, consistent income, but they're also going to be tax efficient. If we take a look at the fund page, we can see the strategy on the targeted benefits. It's going to distribute high monthly income generated by harvesting the constituents of the NASDAQ 100 index by implementing a data-driven call option strategy. And so they're going to be actively managing this ETF, and they're going to take advantage of tax loss harvesting opportunities, which sets this ETF different than a lot of other ETFs because they're keeping investors in mind. Most people are going to invest in these high income ETFs because they're actually going to be using the income directly from a taxable brokerage, whether it's to supplement their income or use it to pay bills, whatever they are using the income for. They're going to be holding it in not tax favored accounts. So they're also going to be utilizing what's classified as Section 1256 contracts, which means it's going to be subject to lower 60/40 tax rates. And this is very good for investors using income immediately. And that is going to be the same strategy across SPY-I, QQQI, and IWMI. Now, the ETF we want to highlight in this video is actually going to be a high income alternative. We can see IAUI. Now, they have a great lineup of income ETFs. We have BTC YRI for real estate, and then we have some hedged equity income ETFs, as well as some US Treasuries, which I have been a personal fan of. But IAUI is a gold high income ETF. It's going to be paying out monthly distributions, and we can see it pays out a respectable 12.63% distribution rate. Now, of course, these distribution rates are subject to change, but they're usually going to be between a 1 to 2% range because of how consistent NEOS has been. And if we take a look at the targeted benefits of IAUI's strategy, it's going to offer monthly income through a data-driven call option strategy on gold ETPs. And we're also going to be getting some capital appreciation on exposure to physical gold. Now, of course, it's not going to be the same capital appreciation as gold itself, because we're using call option strategies, but it's going to have some room to grow, which is a very good thing. And if we take a look at the holdings, it's going to be selling those call options on AAAU, which is going to be the Goldman Sachs Physical Gold ETF. So if we take a look at AAAU, AAAU is going to be pretty much the spot price of gold. It's going to track it as closely as it can, 1-to-1, and we can see it's up about 66% year to date. 5 years, it is up 128%. So gold has been on an absolute roll, as with other alternative income assets such as Bitcoin and other cryptos. So in turn, IAUI has been doing very well as well. And if we take a look at the share price for IAUI, we can see it's up 11 or 12% since inception, which was June 5th of 2025. So in just 4 months, it's up 12% in share price, which is a very good indicator of how we can actually have some capital appreciation with a high income ETF. And of course, you're getting those monthly distributions about 12% annualized every single month. Now we want to compare IAUI to the S&P 500. If we take a look year to date, it's going to be 17%. That year to date is actually only going to be 4 months because this fund only has 4 months of trading, which was June 5th of 2025. And if we compare the S&P 500 during that same period, we can see that it's up only about 14%. So we are beating the S&P 500, which is a very good thing to see, as NEOS has consistently outperformed the market with their high income ETFs. And what's interesting is if we compare those 4 trading months of 17% total return, and keep in mind this is all with dividends reinvesting. So if you are reinvesting your dividends, this is what the total return is going to be since inception. And if we compare it to the S&P 500 for year to date, which is a full 10 months, it is still outperforming by 1.5%, which is quite crazy to see. And that's all thanks to the price of gold, which has absolutely skyrocketed lately. We can see that it is up quite a bit. So a lot of people who have invested in gold this year are pretty happy with the returns. And it's also quite a good indicator of how the economy is heading. A lot of people are losing interest in the dollar. The dollar, by the way, is down 10% on the year. So your purchasing power is 10% less, which is absolutely crazy to see. And that is why gold is up so much. And if we take a look at the value of the dollar, the US dollar index, we can see it's down 9% year to date, which is quite crazy. Inflation has been taking over a lot of people's lives, and that is one of the main reasons people are investing in high income ETFs right now, because people are losing their jobs, they're not getting any raises, cost of living has skyrocketed, so people need to supplement their income with these high income ETFs. They're using them in taxable brokerage accounts in order to help pay off their bills. Even though these are high income products, some people may choose to reinvest their dividends and use it to grow their portfolio. Say you're saving for a house or a car in the near future, you don't want to keep those funds in a retirement account because you are going to need them in a few years. So a lot of people are placing their money into a lot of these NEOS products or their high income ETFs. They're reinvesting their dividends into the fund until they need to use that income. And while it doesn't outperform the actual gold, it is going to be a little less volatile. So a lot of these high income products are not going to perform the underlying in most cases, even with dividends reinvested, because if the underlying skyrockets, you're not going to see that full exposure to the upside. So we can see comparing IAUI, which is up 17% total return, to GLD, it's going to be about 30% versus 17%. So we can see if you had invested in GLD, you would have had a higher return. But these are two completely different products. Of course, if you want that growth, if you want a little bit more stability, you want GLD. But if you're looking for income, you want distributions, IAUI would be the better bet. In my opinion, the best of both worlds would be to have a mix of both growth and income. You don't want to rely heavily too much on income because you may miss out on some capital appreciation. And if you have 100% growth, you may miss out on some short-term returns. Because if the market stays flat, you're not going to receive any income from pure GLD. But if you have IAUI, you are still going to receive income even during a flat market, which is something you have to consider. And we also want to note what the expense ratios are. It's an actively managed ETF, so we're going to be having a higher than normal expense ratio of 0.78%. Now this is quite high. A lot of people are scared of these high expense ratios, especially since a lot of other ETF providers have been lowering their ETF expenses more and more, such as VOO, which is now 0.03%. You're pretty much paying nothing for this ETF. And even Fidelity has came out with 0 expense ratio ETFs. One in particular is going to be FZROX, but this is a mutual fund and it is going to be specific to Fidelity. But we can see we're headed in the direction that these passively managed ETFs are pretty much costing you nothing. But we see with these highly active managed ETFs, they have some pretty crazy expense ratios, but it's completely justified. They have to manage these options trading every single day. It's a lot of work. And in some cases, and in most cases actually, it's quite justified because we're getting such a good return from these ETF products. Now let me know down in the comments what your thoughts are on gold. Are you buying gold itself? Are you buying physical gold or an ETF? Or are you more interested in a high income ETF on gold? Now it's quite a crazy concept in my opinion, but it could be a good play if you split your money half and half into pure gold or just a high income ETF such as IAUI. And of course, check out Neos's ETFs. They have a ton of high quality ETFs. Now they may not be the most exciting, but they have been the most reliable and consistent. They don't pay out weekly. They do pay out every single month. That is something you had to keep in mind. We now have over 100 weekly paying ETFs ever since YieldMax switched their single stock ticker ETFs to a weekly payout schedule. So that is the trend. A lot of ETF issuers are headed towards weekly income, but Neos is still headed old school style with monthly dividends. And I hope in the future they come out with some products that eventually pay us out every single week. It's a little bit easier to manage your expenses if you're getting a higher payout frequency. Let me know down below what your thoughts are.